Hey everyone, and welcome back to Wealth Unlocked by Welment Capital. We're jumping into episode 2, and you know what? This is something we get asked all the time. It's the big question. SIPs or FDs, what's the absolute best way to grow your money? Well, get ready, because that's exactly what we're tackling in this episode. SIP versus FD. What's the best way to grow your money?
It's a question that's on a lot of minds, and for good reason. Both SIPs and FDs are really popular, especially here in India. But they each have their own, quirks and little things you need to understand. And that's really what's going to help you make the right decision for your own financial journey.
Exactly. And that's what we're here to help you do. It's about going beyond just like skimming the surface. We're going to unpack those quirks with clear examples, tackle some of those myths that are always floating around, and hopefully by the end of this, you'll feel confident about making those decisions for your financial future.
Absolutely. So I think a good place to start is with fixed deposits, or FDs, as most people know them. They're kind of like the comfort food of investments, right? Reliable, familiar, and pretty straightforward.
Yeah, I like that. Comfort food.
So you deposit a lump sum with a bank. It's for a fixed period of time, and in return, they give you a fixed interest rate on that money.
So it's like tucking your money away in a safe little spot, like a special savings account, where it earns a little extra.
Yep.
But you know it's not going anywhere.
Exactly. And right now, interest rates for FDs are hovering around 5% to 7% per annum. The big thing here is that no matter what happens in the market, your returns are locked in guaranteed.
Yeah, that peace of mind is definitely a big plus, especially when things feel a little unpredictable. But what about SIPs? Everyone's talking about SIPs. They seem a bit more adventurous, maybe?
Yeah, a bit more adventurous. So with a systematic investment plan, or SIP, you're basically dipping your toes into the world of mutual funds. And the good thing is you don't need a huge chunk of money up front. Instead, you invest a fixed amount regularly, usually monthly. It's like building a fitness habit, but for your finances.
Okay, I can get behind that. And I think the main appeal here is the potential for higher return. Like, are we talking significantly higher than those steady FD rates?
Definitely. While FDs offer that predictability, SIPs, especially those linked to equity mutual funds, they can potentially bring in returns of 12–15% per annum over the long term. Now, that's a pretty big difference.
Okay, I see the allure, but we've all heard it, right? Higher returns usually come with, well, higher risk. FDs feel like a safe bet. Is that the trade-off here? Like, is that what we're looking
And you hit the nail on the head. With SIPs, your returns are tied to the market's performance. When the market is doing well, your investments can really soar. But when things get shaky, you might see your portfolio dip a little. That's just the nature of how it works.
So it sounds like someone who's maybe closer to retirement and needs that stability, they might lean towards FDs, while someone younger who has a longer time horizon, they might be okay with, riding those market waves a little with SIPs.
That's a great way to think about it. It all comes down to aligning your investment strategy with your life stage and how comfortable you are with risk.
Okay, we're starting to see how to make this decision, right? But let's get even more specific. Let's say someone's listening and they're thinking, all right, an FD sounds good to me. When would that be the best choice? Hands down.
FDs are great if you're really after that rock-solid guarantee on your returns. Let's say, for example, you're saving for a down payment on a house, and you know you'll need that money in a couple of years. You absolutely can't afford to lose any of that hard-earned cash. An FD would be a great fit in that case.
Yeah, that makes total sense. It's like that set it and forget it approach. You'll hit your target amount with no surprises. And we talked about retirees earlier. Why are FDs often such a popular choice for them?
It's all about that steady income, right? When you're in retirement, you're often living on a fixed income. You don't want to be worrying about market dips affecting your savings. FDs can provide that reliable stream of income that you can count on month after month.
So it really is all about matching your investment strategy to your life stage and your needs. Okay, so that clarifies the FD side. But let's flip the script for a second. When are SIPs the clear winner? When should people be choosing SIPs?
SIPs really shine for those who have a longer time horizon. They have more time to let their investments grow, and they're a bit more comfortable with the ups and downs of the market. Imagine you're in your late 20s, early 30s, just starting your career. You've got time on your side to ride out those market fluctuations, and you're looking to build wealth for those big life goals, maybe a house, early retirement, travel, things like that.
So it's not about getting rich quick. It's about playing the long game and letting that money grow steadily over time.
Precisely. And remember, we talked about how you don't need a ton of cash to get started. You can start small and dip your toes into that SIP world with a smaller amount.
Okay, I think that makes SIPs way more approachable than a lot of people realize. It's like starting a fitness routine. You don't have to, run a marathon on day one. You build up gradually.
That's a great analogy. The key with SIPs is consistency. Even if you can only spare a small amount each month, that discipline, over time, can lead to some really impressive results.
Okay, we're getting a clearer picture of how these two options stack up against each other, but I think it would be helpful to see them side by side, like a head-to-head comparison. What do you think?
I think that would be really helpful for everyone listening. Let's do it.
All right. First up, the big one, risk level. We already talked about how FDs are low risk. They have those guaranteed returns, while SIPs, they're a bit more, adventurous. Their returns are linked to how the market performs.
Right, and that ties directly into the next point, returns. With FDs, you're looking at that steady 5–7% per annum. But SIPs, especially those equity-linked ones, have the potential to hit those much higher returns, 12–15%, but remember, it's over a longer time frame.
Okay, so risk and potential reward are the first two things we're comparing. What about liquidity? How easy is it to actually get your money if you need it, like right away?
With SDs, you can usually pull your money out early if you absolutely have to, but there's almost always a penalty fee. It's like a little, hey, think about this a bit more from the bank.
Got it. So it's a little less flexible than SIPs, right? Because with SIPs, you can withdraw anytime, although there might be what's called an exit load.
Exactly right. An exit load is just a small fee. It's charged if you withdraw your SIP investment within a certain period, usually within the first year or so. It's meant to encourage investors to stay committed and ride out any ups and downs in the market.
So while SIPs are more flexible when it comes to getting your money, there's still some things to keep in mind strategically. Okay, next up, the big one, compounding. What's the difference between how FDs and SIPs handle this?
FDs work on simple interest, meaning you earn interest only on the initial amount you invested. But with SIPs, you've got the benefit of compounding, and that means your returns start earning their own returns. It's like imagine a snowball rolling downhill. It picks up more and more snow as it goes. Your wealth can really grow exponentially.
So compounding is where those long-term returns with SIPs can really take off. It's like that saying, the best time to plant a tree was 20 years ago. The second best time is now.
Exactly. And while we're talking about the benefits of SOPs, we can't forget about taxes. The interest you earn on FDs is fully taxable, but with SIPs and equity mutual funds, you get some tax breaks. Long-term capital gains tax only applies if your gains go above a certain amount, which is currently 1.25 lakh rupees.
So there are some tax advantages to think about with SIPs, especially for those who are looking to grow their wealth over the long term. Okay, I think we've covered a lot of ground here. I think it's time to move to part 2 of this episode, where we tackle the big question. Which one actually builds more wealth? SIPs or FDs? Stick around, you won't want to miss this.
Welcome back to Wealth Unlocked by Welment Capital. We're diving deeper into SIPs versus FDs, and I think this is where it gets really interesting, especially if you're ready to make some investment decisions.
Yeah, it's decision time. We've laid the groundwork right, explored the pros and cons, busted some myths, but now we need to figure out what's the right path for you, for our listeners.
Exactly, and that's where your individual financial goals and your risk tolerance really come into play. And we've said it before, but I think it's worth repeating. There's no one-size-fits-all answer. It's all about what works best for you.
Okay, so let's get into it. We looked at that side-by-side comparison, and I'll be honest, it made me think, wow, SITs seem like the clear winner. But I know it can't be that simple. So let's play devil's advocate for a minute. When would an FD actually be the smarter choice? When would you recommend someone go with an FD?
You're right. It's not always about chasing those highest potential returns. Sometimes it really is about that safety and peace of mind. Let's say, for example, you've worked hard your whole life, saved up a good amount for retirement, and you need a guaranteed income to cover your expenses. In that case, using a strategy called laddering FDs could be a really smart move.
Laddering FDs. Okay, I've never heard of that. What is that?
It's a technique where you split your investment into multiple FDs. Each one has a different maturity date. And as each one matures, you can either reinvest it or use those funds for your expenses. It's kind of like creating your own personal pension plan using FDs.
Ah, I see. So even for long-term goals like retirement, FDs can still be helpful. especially if you're strategic about it.
Absolutely. And remember, FDs can also be a good fit for those shorter-term goals where you need a guaranteed return and you absolutely can't risk losing any of your principal, like we talked about before, saving for a down payment on a house.
Okay, I'm starting to the value of FDs now, but let's switch back to SIPs. When would they be the hands-down best option? Like, when would you say go with the SIP?
If you're looking to build a good amount of wealth over the long term and you're okay with a little bit of risk, a little volatility, SIPs can really make a big difference. Remember that example we talked about before, investing 10,000 rupees each month for 20 years. Let's say you put that in an FD at 6% interest. Your investment will grow to about 48 lakh rupees, which, isn't bad.
Definitely a decent return. But I have a feeling you're about to tell me something amazing about the SIP.
Get ready. If you invested that same 10,000 rupees each month in an SIP, and we're assuming an average return of 12%, well, after 20 years, your investment could be worth a whopping 1.92 crore rupees.
Wow, okay, that's a huge difference. That's
Yeah.
life-changing kind of money. But let's be realistic. Getting a consistent 12% return for 20 years, that almost sounds too good to be true. How likely is that to actually happen?
Yeah, you're right to be cautious. No investment can guarantee those kinds of returns all the time. The stock market historically tends to give better returns than FDs over the long term, but there will always be ups and downs. And that's where your risk tolerance and your patience are so important.
So it's not about just throwing money into an SIP and hoping to become a millionaire overnight. It's about understanding that there are risks involved and being prepared for those ups and downs.
Exactly, and that's why diversification is key. When you invest in a mutual fund through an SIP, you're spreading your risk across many different stocks or other assets. It's like they say, don't put all your eggs in one basket.
Right. So even if a few of the investments in that basket don't do well, others might pick up the slack, and that helps smooth out those returns over time. I'm starting to see how it all works now.
And there's something else we talked about earlier that I want to mention again. Rupee cost averaging. It's built into the SIP structure, and it basically means that because you're investing that fixed amount regularly, you end up buying units of the mutual fund at different prices. So when the market dips, you're getting more units for your money, and when the market rises, you're buying fewer. This helps average out your purchase price over time and can potentially lead to even better returns.
Okay, I'm getting it now. SIPs can be a really powerful tool for building wealth over the long term, especially when you understand these things like diversification and rupee cost averaging. It's not just about luck, it's about making smart decisions.
Exactly. And remember, you don't need to be a financial expert to get started with SIPs. There are so many resources available to help you choose the right mutual funds for your goals and your comfort level with risk. And if you want that personalized advice, you can always talk to a financial advisor.
Great advice. Okay, we've talked about the best times to choose FDs or SIPs, how to use those strategies like laddering and diversification, and we even looked at some numbers to see that potential for growth. I'm feeling way more informed already, so before we jump into the final part of this episode, maybe we should do a quick recap, just to make sure everyone's on the same page.
Yeah, I think that's a good idea. The most important thing to remember is this. Both SIPs and FDs have their own strengths, and they can both be part of a well-rounded financial plan. It's not about picking one over the other forever. It's about figuring out what works best for you, for your goals, and your risk tolerance.
Exactly. And there's nothing wrong with starting small. The important thing is to just get started. Whether it's 500 rupees or 5,000 rupees, every bit counts.
I totally agree. Time is on your side when it comes to building wealth. The earlier you start, the more time your money has to grow. So don't wait for that perfect moment. Just take that first step.
Do you have any final thoughts for our listeners before we wrap up today?
I think the biggest takeaway from our discussion today is that knowledge is power. The more you know about your options, the better decisions you can make about your money. So ask questions, do your research, and if you need help, don't be afraid to talk to an expert.
Absolutely. And that's what we're all about here at Welment Capital. We want to help everyone unlock their financial potential and reach their goals. And that might mean using SIPs, FDs, or a mix of different strategies. It all depends on you.
Exactly. So if you're feeling inspired and ready to take that next step, we're here to help. Come find us on Instagram or send us an email at contact.wellman@gmail.com.
We're here for you every step of the way. And remember, the best time to plant a tree was 20 years ago. The second best time is now. So what are you waiting for? Start investing today.